wabarakatuh. My name is Laila and today we're super excited to present our group project. So just to intro a bit, we are all in semester 2 taking the accounting course and we are from class 2C from UITM Alugajah. This project is for our subject MAF503 Financial Management and it's all about exploring SME in Malaysia. Before we dive in, let me introduce our group members. My name is Laila.
My name is Arina.
Hi, I'm Adia.
My name is Injera and I will explain in the
Now
last
that
part.
you've met all of us, let's quickly go through what you'll be seeing in this video. From this video, we will cover what is an SME in a Malaysia context, the characteristic and role of SME in Malaysia, and what leads to the difficulty and obstacle SME face in securing bank credit. Sounds serious, right? But don't worry, we'll explain it in a fun way. So do you ever wonder what is SME actually? Seriously, what even is an SME? Why are we doing this and why are we stressing over it? Okay, let me explain it properly. According to the official SME Corp Malaysia website, yes, this is legit. An SME, which stands for Small and Medium Enterprise, is basically a business that's not too big and not too tiny. It's just in the middle. In the service sector, which include food and beverage, aka our favorite makan spot, an SME must have less than 75 full-time employees or make less than 20 million per year. So, if your burger stall has 30 workers and make 5 million, SME. If you have 100 workers and make 90 million, sorry boss, you're not SME anymore. Okay, so now that we kinda know what SME is, let's look at some real-life food and real-life example. First up, Mama Sub. If you haven't seen viral cakes or frozen food online, chances you have seen her. Mama Sub built her bakery empire using social media and WhatsApp group. Second, K-Fry, Korean fried chicken lovers, rice. It started in Johor and now has a few outlets around Malaysia. Crunchy, cheesy, spicy, SME style. And last but not least, My Burger Lab. Founded in 2012 by a few burger nerds, now they're famous for those black chuckle buns and weird but awesome burger like ayam bakar and nasi lemak rendang burgers. This business all started small but become big in our heart. But wait, what makes this SME different from the big guys like McDonald's, Starbucks or KFC? Let's break it down, SME style. Number 1, smaller scale. SME usually start with a fewer outlets and smaller teams, like K-Fry. They only have few locations in Malaysia, while McDonald's is literally on every highway exit. Number 2, more flexible and creative. SME brand experiment with new menus all the time. Just look at My Burger Lab website. They have dropped nasi lemak burger, ayam bakar burger. Who even thinks of that? It's wild. Number 3, close customer relationship. SME often build strong community vibe. For example, Mama Sub doesn't just sell food, she has a whole loyal fan base. There's even Mama Sub community group you can join online. That's how tight their bond is.
And now we will cover the role of SMEs in Malaysia. Here we have a job creation, economic contribution, and also innovation. So let me start with a job creation. In Malaysia, small and medium enterprises or SMEs are not small in impact. They are actually the backbone of the nation's economy. In 2023, SME contribute over 630.1 billion, making up the 39.1% of Malaysia's total GDP. Even more impressive, they provided jobs to over 7.86 million people, which is 48.5% of the national workforce. But beyond the numbers, SMEs are Malaysia's biggest job creators, from local warungs to the digital startup. These businesses create jobs in almost every sector, especially for young. SMEs also play a major role in the youth employment. They hire students, fresh graduates, and part-timers, to giving them a real chance to gain soft skill, experience, and also financial independence. And that leads to the next role, encouraging entrepreneurship. By exposing young Malaysians to the real world of business, SMEs ignite confidence and ambition. Many go on to become freelancers, start online shop, or launch food brands of their own. With government support from MDAG, SME Co-op and initiatives like 100 Go Digital, it's easier than ever for young entrepreneurs to start from scratch, even with just a smartphone and internet connection. Next, we move to the next role, which is economic contribution. Small and medium enterprises or SMEs may be small in size, but their contribution to national economy is massive. In 2023, they contribute over 630.1 billion to the national gross domestic product. That is huge. 39.1% of nation total GDP according to the data from the Department of Statistics Nation. But it doesn't stop there. SME are also a major job provider. They employ more than 7.86 million workers in 2023, making up 48.5% of the entire workforce. From retail shop to the tech company, SMEs offer employment across almost every sector, especially for students, fresh graduates, and the rural communities. On the global front, SMEs are also boosting Malaysian trade. In 2023, SME export reached RM152.2 billion, contribute 12.2% to the Malaysia total export. More SMEs are selling products internationally through the platform like Shopee, Lazada, and also Alibaba. So, whether it's through the GDP, job creation, or export, SMEs play a vital role in driving national economy forward. They aren't just surviving, they are helping the nation grow locally and globally. And lastly, we have innovation. Innovation doesn't only happen in the big tech companies. In Malaysia, it's often the small and medium enterprises that lead the way. Next, we'll look at the technological adoption. With strong government support, more SMEs are embracing digital tools like e-invoicing, QR payment system, cloud services, and social media marketing. In recent years, thousands of SMEs have joined digitalization programs that help them upgrade their system and improve productivity. This isn't just about keeping up, it's about staying ahead in the digital world. Their greatest strength? Yeah, that is adaptability and agility. Unlike large corporations, SMEs are flexible. They can quickly adjust to change in market trends, consumer behavior, and even a crisis. During the pandemic, thousands of SMEs moved their business online almost every night. Cafes start food delivery, boutiques began live streaming, and traditional stores create e-commerce pages, proving how fast SMEs can adapt when it matters most. And let's not forget about product and process innovation. SME constantly create a new offering to meet changing customer needs. A great example is My Burgerlet. They didn't just sell burgers, they reinvented their experience, from launching viral flavor like charcoal bun to creating DIY burger kit during lockdown. They have shown how small business can innovate and thrive. Behind the scenes, they even use smart kitchen tools for better quality and speed, improving not just what they sell, but how they sell it.
Today, I'll be presenting one of the key challenges faced by small and medium enterprises or SME, which is access and affordability of credit. SMEs often struggle to get loans from banks. This is due to several reasons, which is strict banking requirements, lack of sufficient collateral, limited or no credit history, and a high level of perceived risk by financial institutions. In developing countries, this issue is even more serious. Around 40% of former SMEs face an unmet financing need that total approximately $5.2 trillion every year. That's a huge gap, and it clearly shows how tough it is for SME to grow or even survive without proper access to funds. One effective solution is the use of credit guarantee schemes or CGC. For example, in Malaysia, SJPP and CGC are two major institutions that offer loan guarantees which is covering up to 80% of the loan amount. This means that banks are more willing to lend money to SMEs even if they don't have full collateral. In short, CGC reduces the risk for banks and improves access to financing for SME. By using credit guarantee schemes, we can bridge the financing gap and empower SMEs to grow and contribute more to the economy. Now, let's move on to another common issue faced by SME, and that is cash flow and working capital constraints. Many SME experience delays in customers' payments and slow funding approvals, which can take more than a month. On top of that, limited liquidity makes it hard for business to manage daily operations and support growth. These cash flow challenges can prevent SMEs from paying suppliers, restocking inventory, or even paying salaries on time, which disrupt overall business performance. One way to overcome this issue is through alternative financing strategies. For example, SMEs can sell their receivables, which means they can get immediate cash instead of waiting for customers to pay. This is often done through factoring. Another method is to borrow against existing assets like inventory or equipment. This allows business to unlock cash from what they already own, helping them to manage operations more smoothly. So, by using these financing options, SME can improve their cash flow, manage working capital effectively, and continue growing without unnecessary delays.
Let's look at another major challenge, which is limited product diversity in financing options for SMEs. The problems, as traditional banks become more cautious and reduce their lending activities, many companies are finding it difficult to access the funds they need. This affects their ability to grow, to innovate, or sometimes even just to stay in businesses. When financing options are too limited, SMEs have fewer choices, especially when they don't qualify for standard bank loans. What is the solution? So, the key here is to diversify financing sources going beyond traditional credit. Some of the alternative financing options include crowdfunding, either equity bids or rewards bids, peer-to-peer P2P lending, revenue-based financing, supply chain financing, and merchant cash advances. This alternative provides more flexible and accessible ways for SMEs to raise funds depending on their specific needs and circumstances. By embracing these diverse financing options, SMEs can improve their chances of survival and success, even when traditional banks say no. To conclude our discussion, evaluating SME loan applications requires a thoughtful balance between encouraging business growth and managing financial risks. Small businesses are key players in driving economic development and creating jobs, but at the same time, they often come with higher risks. This is because many have limited financial histories, not enough collateral, or operate in unpredictable markets. That's why lenders apply structured risk assessment criteria. These include evaluating creditworthiness, analyzing cash flow, measuring debt service capacity, and understanding the purpose of the loan. Using these criteria helps lenders make smarter, more reliable decisions. It reduces the chances of defaults and ensures that funds go to SMEs with strong, sustainable business model. In the end, this logical and criteria-based approach not only protects lenders, but it also supports a healthier, more resilient financial system for everyone.